Welcome back to the Deep Dives. Today we're zeroing in on HCL Technologies, specifically their Q2 FY26 earnings call and all the related financials.
Right. We've got the statements, the call transcript, lots of material here.
And our goal really is to cut through the usual earnings call jargon and figure out what's actually shifting structurally, especially with their, well, very aggressive push into AI.
Yeah, management themselves called it a strong and energizing quarter. And you can see why. The growth looked pretty broad-based, and importantly, the operating margins recovered quite a bit.
Right.
So our focus today is really unpacking how they pulled that off, how they managed to, stabilize the profits while also diving headfirst into these advanced AI services, which frankly sounds like it could disrupt their own existing business too.
Let's start with those headline numbers then. Just the basics, reported in constant currency, right? To smooth out the exchange rate noise.
Correct. So revenue was up 4.6% compared to last year and 2.4% just in the previous quarter.
Okay, steady growth. But you mentioned the margin recovery.
That was the real eye-opener, I think. Operating margins jumped back to 17.5%. That's a sequential increase of 116 basis points.
Wow, okay. 116 basis points. That's over a full percentage point jump in just one quarter.
Exactly. And remember, a basis point is tiny, 1/100th of a percent. So that kind of leap, it really signals that their internal efficiency plan, the one they've been talking about, is actually working. They're executing.
And that confidence, that stability, it flowed through to shareholders too. The board announced an interim dividend, 12 per share.
So financials look healthier. Now let's talk about what's driving the future growth, the pipeline.
Okay, right. Let's unpack the bookings because the number they reported this quarter, it really sets the stage for the next, 6 months or so.
It does. The figure was $2.6 billion in new bookings. Now, that's a big number on its own.
It sounds big.
It is. But what's really fascinating, the critical context here, is how they got there. This is the first time they've ever crossed the $2.5 billion mark without needing a single mega deal to prop it up.
Okay, hold on. That's unusual, isn't it?
Yeah.
Usually, for these big services firms, you expect one or two massive, whale deals to make up a huge chunk of that booking number.
Exactly.
So if HCL Tech hit this record without one, does that mean their sales engine is just, firing on all cylinders everywhere?
Yeah.
Or could it mean something else, maybe deals getting smaller, more fragmented?
In this climate, I think it signals real diversified strength. It suggests they're winning consistently across different types of services, different regions, different clients, lots of solid, maybe smaller, but high-value recurring deals.
A broader base.
A broader, probably more resilient sales base than just relying on a couple of huge contracts landing perfectly. And management did mention two fairly large deals that were actually delayed from Q1 finally closed this quarter. So clients are perhaps getting less hesitant.
Right, pulling the trigger on spending again. And just a quick reminder for everyone listening, why bookings matter so much.
Yeah, it's the fuel for future revenue. New bookings usually translate pretty directly into actual revenue growth, typically with a lag of, say, 1 or maybe 2 quarters.
So this $2.6 billion should really start showing up in the Q3 and Q4 results.
Precisely. And it kind of bolsters their whole narrative that AI isn't just talk anymore. It seems to be embedded somehow in almost every deal getting signed now.
Okay, well, that's the perfect segue. This brings us right to the core of this deep dive, the big structural change.
Yeah.
The AI piece, they hit a very specific, very public revenue number tied just to AI.
They did. They announced over $100 million in revenue specifically from advanced AI in Q2.
$100 million. Okay, how significant is that in the grand scheme of HCL Tech?
Well, relative to their total size, it's about 3% of their total revenue right now.
Why flag that number, do you think? Why $100 million? It feels like a deliberate signal they're sending.
Oh, absolutely deliberate. It's like planting a flag. They're basically saying, look, real measurable revenue from this new AI stuff, not just pilots, it's happening now.
And they were careful about defining it too, aren't they?
Very careful. They stressed this is advanced AI, so it specifically excludes the kind of classical AI work they've always done, like basic data analytics or simple automation.
Got it. So this is the cutting edge stuff. Gene AI, agentic AI.
Right. Physical AI, dedicated AI engineering teams. It's the new wave.
And the language from management around this was surprisingly blunt almost. They said they're moving from a people-based business towards a model that seamlessly blends AI IP with human-in-the-loop capabilities.
That quote really says it all. It confirms they are actively trying to transform. And crucially, they seem willing to disrupt their own existing business to do it.
Cannibalize their own revenue streams.
Well, they recognize that if they don't make their older, slower growth services more efficient using AI, somebody else definitely will. So better to lead the disruption themselves.
Okay, so that self-disruption idea, it feeds into their formal AI strategy, right? They laid out 4 key points.
Yeah, 4 pillars. First, as we just discussed, proactively transforming their own services, even if it hits existing revenue short term.
Makes sense. What's second?
Second is crucial for a services company like them, investing heavily in their own differentiated IP, intellectual property, things that help them scale AI for clients quickly and, safely.
So while the giants like NVIDIA or Microsoft build the underlying AI models,
Yeah, the core intelligence.
HCL Tech's angle is to build the proprietary tools, like their AI Force platform, that make that intelligence actually usable and scalable inside a big company, a Fortune 500 client.
Exactly right. Making it enterprise ready. The third element is then expanding into brand new services built around AI. Think like an AI factory concept, offering AI advisory to executives, building dedicated AI engineering teams.
Okay, new service lines, and the last one.
Fourth is strengthening partnerships, working closely with everyone in the ecosystem from the chip makers, the GPU providers, all the way up to those specialized AI model companies and agentic platform providers, covering the whole stack.
And we're already seeing that IP investment paying off, apparently. They mentioned their AI Force platform, version 2.0 is in beta.
Yeah, aiming for general release GA in January 2026, but it's already deployed in 47 accounts. That's up from 35 just last quarter.
Quick uptick.
And the goal is to get their top 100 clients using it pretty fast.
Okay, so the strategy is clear, the IP is developing. But this raises the big question. How is this actually playing out with clients? We need some real-world examples, right? Beyond the strategy decks.
Absolutely. We need concrete business outcomes.
Well, the call actually provided some pretty good ones. In retail, for instance, they signed a big legacy system modernization deal with a European retailer. And they used AI Force for it.
And the result?
Apparently, it automated a lot of the design, build, and testing work. They reported a 30% to 40% increase in developer productivity within the software development lifecycle, the SDLC.
Wow, 30 to 40%. That's not trivial. That's a serious efficiency gain, an immediate ROI for that retailer.
Definitely. Then there was an interesting one in aerospace. A Fortune 100 company using HCL Tech's physical AI.
Physical AI, what does that entail? In this case, it was for contour scanning software and building simulation test beds, basically speeding up how they validate precision manufactured parts.
Okay, interesting application.
Right.
And one more showing the really high-end stuff.
Yeah.
A large U.S. telecom hired them to launch an AI lab powered by NVIDIA Tech.
Yeah.
And they're deploying really advanced models there, things like Llama 405B, Maverick, Scout. So right at the bleeding edge.
Okay, so those are examples of new work, new revenue, new efficiencies being created by AI. Good news.
But there's always a but.
There is. We have to talk about the other side of the coin. AI isn't just creating new opportunities, it's making some of the existing traditional work cheaper, much cheaper.
This is that productivity deflation idea.
Exactly. And management basically confirmed it's happening right now in their current business.
How did they confirm that? What did the numbers show?
It was really clear in their contract renewal data. So they looked at their top 10 renewals for the quarter. 5 of them renewed with a higher annual contract value, or ACV. That's great. It means they expanded the work, consolidated services.
Okay, good sign. But the other 5?
The other 5 renewals saw their ACV decline. And management explicitly said it was because of AI-driven productivity gains being passed on.
Wow. So even within their biggest, most important accounts, AI is already pushing prices down for traditional services, things like BPO, application management.
That's right. Business process outsourcing, BPO, seems particularly vulnerable. If AI can suddenly do, say, half the work involved in a BPO process.
And the client expects to pay less, naturally. So is the new work, the modernization deals, the AI factory stuff, is it growing fast enough to offset that deflation happening in the core business?
That is the multi-billion-dollar question for the entire IT services industry right now. And HCL Tech, to their credit, are being pretty open about it.
What are their estimates for potential deflation?
They reckon the biggest impact, the biggest potential efficiency gain is in BPO, maybe 40% to 50%. And in the software development lifecycle, SDLC, maybe 25% to 30%.
Huge numbers.
They are. The saving grace, perhaps, is that actually rolling out these efficiencies across massive, complex client organizations takes time.
Hmm.
It's not instant. They figure it'll take a couple of years to fully scale.
Which buys them time, right? Gives the sales teams a window to land those new, hopefully higher margin AI transformation projects to sort of rebalance the books.
It puts immense pressure on them, though. You're essentially telling your long-term client, hey, great news, we can now do tasks A, B, and C for the price of just A and B.
And by the way, now you need to buy this brand new, complex, expensive service X from us.
Exactly. Their whole strategy hangs on how quickly they can generate that new demand, what economists call demand elasticity. How much new work can they create to replace the value lost to deflation in the old work?
Okay, a really critical balancing act. Let's switch focus slightly to the financials again, specifically that big margin jump we talked about earlier.
Yeah.
Recovery to 17.5% EBIT margin. What exactly drove that 116 basis point leap in just one quarter?
It was a mix of factors, really, layered on top of each other. The biggest single contributor was better utilization, basically, having more of their employees actively working on billable projects and general efficiencies from that internal program they call Project Ascend.
Okay, how much did that contribute?
That was about 50 basis points, and that feels like sustainable core operational improvement, which is good news.
0.5% just from getting more efficient internally. Impressive. What else?
Their HCL software division also performed better, adding about 35 basis points to the overall margin.
Okay, so that's 85 basis points from operational improvements. Still leaves a chunk of that 116 total.
Right. And this is where we need to look a bit closer. A significant chunk came from, let's say, non-operational or perhaps temporary factors. There was a nice tailwind from foreign exchange rates, specifically the Indian rupee depreciating. That gave them a 56 basis point benefit.
Ah, Forex gains. Helpful, but not something you can rely on every quarter.
Exactly. And also, they didn't have a one-off financial charge that they did have back in Q1. The absence of that hit added another 30 basis points this quarter.
Okay, so if you add up the Forex gain and the absence of the Q1 charge, that's 86 basis points right there. More than the operational gains.
It is. So while the recovery is real, you have to ask how much of that 116 basis point jump is truly sustainable, core improvement versus temporary boosts. The sustainable bits seem to be the 50 BPs from Project Ascend and the 35 from software. That's the foundation.
Got it. But we also need to consider things pushing the margin down, right? Weren't there restructuring costs?
Yes, absolutely. They are doing quite a bit of internal restructuring, likely to align with this whole AI pivot. Those costs had a negative impact of 55 basis points this quarter.
Ouch. So that offset some of the gains.
It did. And management was clear that this restructuring isn't finished. They expect it to continue dragging on margins a bit in Q3 and Q4 as well.
So investors probably shouldn't expect margins to just keep climbing at this rate, especially with other known headwinds coming up.
Definitely not. The company kept its full-year margin guidance unchanged at 17% to 18%, and that guidance already includes the impact of their upcoming annual wage hikes.
Ah, the salary review cycle. When does that hit?
They expect a pretty significant impact in Q3, around 70 to 80 basis points down, and then another incremental hit in Q4, maybe 40 to 50 basis points more. So those pay rises will definitely eat into some of the efficiency gains we saw this quarter.
We paint a more balanced picture for margins going forward. Before we leave financials, anything on their workforce? They mentioned something about visas, I think?
Yeah, they briefly touched on it. They highlighted that they're reducing their reliance on temporary work visas, like the H-1B in the U.S. The strategy is more towards hiring locally in their major markets and investing more in training those local hires.
Which ties into building a more resilient, truly global delivery model, I suppose. Less dependence on visa policy fluctuations.
Exactly. It probably costs more upfront in terms of recruitment and training, but it potentially reduces long-term risks and costs associated with visa dependency.
Okay. So pulling it all together, what did this quarter mean for their actual client base? Where did the growth come from geographically and by industry?
Well, the growth pockets were pretty much where you'd expect them to be, given the AI focus. Financial services was strong, up 11.4% year on year. And the technology sector itself, the company's actually building and driving a lot of this tech, grew 13.9% for HCL Tech.
So they seem to be winning business in the sectors that are spending the most on modernization right now.
It looks that way. Geographically, Europe continued its good run, up 7.6% year on year. And the rest of world segment was actually the star performer, up a huge 17.9%.
Wow. And the U.S., their biggest market.
The U.S. grew too, but more modestly, 2.4% year over year. Still positive, but lagging the other regions a bit this quarter.
Were there any specific areas of weakness they called out?
They did mention one ongoing headwind, the slowdown in the automotive sector, which impacts their broader manufacturing vertical. That seems to be reflecting wider economic pressures affecting car makers.
Okay. But on a positive note, you mentioned the software business earlier. Wasn't there some external validation for them then?
Oh, yeah, quite significant, actually.
Yeah.
HCL Software got named a leader in the latest Gartner Magic Quadrant for Application Security Testing. That was for 2025.
A leader. Weren't they ranked lower before?
They were only a challenger back in 2023, so that's a big jump up based on Gartner's assessment of their completeness of vision.
Which ties back nicely to that strategy point about investing in their own differentiated IP, doesn't it? It seems to be getting recognized.
Perfectly. It validates that second pillar of their 4-point AI strategy we talked about.
Okay, let's try and wrap this up then. A quick recap of the key takeaways, the knowledge nuggets we pulled out today.
Sure, I'd say. Number one, those record bookings. $2.6 billion, achieved without a mega deal, which signals real breadth in their sales success.
Right. Number two, that very explicit $100 million advanced AI revenue figure. It's small now, maybe 3%, but it's a clear benchmark they've set.
And number three, maybe the most important structural point, is that delicate high-stakes balancing act they're already performing between AI driving down the cost of old work, that productivity deflation, and the urgent need to sell new, higher-value modernization and AI services.
Okay, so that sets up the final thought, the provocative question for you, our listener, to chew on.
Yeah, the key thing to watch, not just for HCL Tech, but for this whole industry, is really about that trade-off. We know AI is getting baked into almost every new deal. We know it's making existing work cheaper, sometimes dramatically so.
Which cannibalizes current revenue streams.
Exactly. So the critical question is, what rate of new demand, what level of demand elasticity for things like modernization, AI factories, AI engineering, what rate is required to offset that deflation and ensure the overall business and the industry can actually sustain growth?
That's the financial tightrope they're walking.
It absolutely is. And watching how HCL Tech and their peers navigate that over the next year or two will be fascinating.